Okay, we're going to get things started here. So my name is Jack Bruton, and I'm joined here with my colleague Ryan Strong. We're part of the client services team at Morningstar CPMS. This is our Q2 market review. Ryan is going to start things off by taking you through the Canadian side of things, and I'll follow up by doing the US. Please keep in mind this session is being recorded, so you will get a copy of the slide deck as well as the presentation here. Ryan, you can start things off.
Thank you, Jack. As Jack mentioned, I'm going to be covering the Canadian portion of the quarterly market report for Q2. After the call, feel free to email us at cacpmssupport@morningstar.com for any new ideas or feedback. We'd greatly appreciate that. So we're going to follow the traditional format, looking at market performance first, secondly, best sector and stocks, then single factor analysis and model performance, and then lastly, we'll close it off with market fundamentals and outlook. So looking at price change only, in April, the TSX comp climbed 10.5%, and then chugged along in May and June as well. So 16% from a price change perspective over the quarter. Breaking that down, small caps led the way with a 38.5% return in Q2, and this is from looking at total return. And then the TSX comp was up 17% in Q2. From a total return perspective. Market breadth, just as a reminder, the way we calculate this, any stock that was up for the quarter counts. So whether it was up 1% or 100%, it counts. So 89% market breadth for small caps, 88% for TSX comp, and 76% for the TSX 60. So breaking that down by sector, all sectors posted a positive return except for communication services, which was flat. And then on the right, there's the best and worst performer in each individual sector. And then just another visualization showing the sector returns with materials leading the way and then consumer discretionary following behind. So Real Matters, you might have seen on the previous slide, was the best performing stock in the real estate sector with an 89% return. So Real Matters, if you're not familiar, is a technology company focused on real estate and insurance. And it's actually owned in several of our CPMS pre-built models. So on the far left, you can see the strategy. And then as you move to the right, you'll see how Real Matters ranks in the strategy, whether it's recommended as a buy, sell, or a hold. And then the little red palm means that it's currently held. And the purchase date. So for instance, in asset growth, we purchased Real Matters February 3rd. And then on the right of that, we're up about 98.22% on the stock. So if you're not familiar with the asset growth strategy, it looks at or it weights on variables such as reinvestment rate using current year median EPS, reinvestment rate using a trailing dividend in EPS, and then as well as an earnings surprise variable and an estimate revision variable. So this strategy, along with a number of others, have captured Real Matters and taken advantage of the gains there. If you recall this slide, which was new in Q1, we're just comparing how the TSX looked at various important dates so far this year. So in the first column, we have the metrics as of November 18th. And then as you move to the right, March 23rd, and then April 17th, and then June 30th, so the end of the quarter. March 23rd being significant because it was the bottom of the market. So from March 23rd, the bottom of the market, till the end of the quarter, yield has dropped down to 3.3%, which isn't surprising as the market has significantly bounced back. But however, estimate revisions have been further slashed to 23.7%. EPS growth is now down at 30.9%. and price to earnings has increased to 21.4%. Jack will take over this slide.
Yeah. Thank you, Ryan. All right, so this slide is something new that we wanted to add in. So this is the top 15 stocks trading at a discount from our analyst team out in Chicago. So essentially what they do is they derive a fair value price, which is this MS fair variable right here. And what they do is they put in their assumptions and their inputs into a DCF, and it pops out one of these fair value estimates. It is significantly a lot more complicated than that. But if you do want to get some more information on our methodology, you could see just right down here that link that'll take you to our methodology report. So at Morningstar, really what we are long-term value-oriented investors that invest in solid businesses with distinct competitive advantages and have an economic moat. We will touch on the moat very shortly. So this MS fair value is what we think the stock should be trading at. The PR now is the price now. The RMS fair is essentially it's the potential upside. So Afria has a 257% potential upside. Now this MS moat right here, so we're looking at 5 specific factors when assigning this moat. So we're either going to assign it a no moat, which would be 0, a narrow moat, which would be 3, or a wide moat, which is the best, and that would be assigned a 5. And when we're looking at assigning these moat ratings, we're looking at things like intangible assets. Do they have any IP, any patents, brands? Are they protected by the government? From a cost advantage standpoint, are they able to produce their products at a lower cost than their competitors? Switching costs, is it a major pain to switch from one competitor to another? You know, a perfect example there would be switching from TELUS to Rogers. If it's a major pain for me to do so, I may just stick with the status quo and do nothing. Network effect is, I think it's personally one of the strongest ones, but that's my opinion. So network effect works as follows. So an example would be Facebook. So let's just say I have a group of friends who are currently registered on Facebook and I am not on Facebook. So in order to get in contact or communicate with them, I'll have to sign up for Facebook. So that means that's good for Facebook because it has more users, more potential ad revenue. Now let's just say once I'm already on Facebook, I have another group of friends who want to get in contact with me who are not currently users of Facebook. They will have to sign up for Facebook, and it really creates this vicious cycle that goes around and around and is extremely powerful. And then finally, we look at efficient scale. So efficient scale is classic economics. It's when an industry or sub-industry is effectively governed or it's effectively run by just a few players, and players that are not within that industry won't enter, because if they did enter, it would become unprofitable for the entire industry, so they stay out. And then finally, we're looking at MS star. So MS star is essentially, it is a 5, means that it offers the highest risk-adjusted return. Thank you, Ryan. Go on.
Thanks. So next, we're going to look at Q2's best and worst performers. So to do that, we take the top 50 stocks in the CPMS universe on average monthly volume. So energy and materials led the way for best performers. And in terms of worst performers, it was a bit of a mixed bag, but quite a lot of communication services and real estate, as you could expect. So here we, in the first column, we're taking the top 50 stocks, and in the second column, the bottom 50 stocks, and we're taking a look at their attributes at the beginning of the quarter and how they looked. So at the start of Q2, the best 50 stocks, interestingly enough, were higher beta, had higher earnings variability, had lower estimate revisions, lower earnings momentum, and were undervalued. And the worst 50 stocks had a negative earnings surprise, estimate revisions were flat, they were slightly undervalued, and poor growth characteristics. So what fundamentals did the market reward in Q2? So this looks a little bit different than Q1. If you remember, in Q1, not many variables were actually outperforming the general market, where sort of things flipped in Q2. where I think investors were looking at cash flow metrics. Could a company sustain the current market environment? So no surprise that expected price to cash flow was the #1 return for Q2, and then trailing price to cash flow not far behind. And then lastly, style analysis. So here are the CPMS model strategy returns. Earnings momentum leading the way at 39.5% return for Q2, and the majority of the CPMS strategies outperforming the TSX comp. So here, looking at valuations and profitability, the CPMS universe within Canada. So we're anticipating profitability to actually decrease. So ROE is decreasing, where price to book is increasing at the same time in Q2. Average EPS growth decreased over the quarter, and estimates are actually looking downwards. So we're expecting more cuts for Q3. Estimate revisions and earnings surprise. So earnings estimates are starting to bounce back as the economy reopens, but still a long way to go to the pre-COVID levels. Across the board, every sector estimate revisions have been slashed, most notably consumer discretionary at -57%, as well as a bit of a mixed bag for expected ROE, but with expected EPS growth negative across the board. Beats and misses of the TSX comp, it was almost split down the middle, 50-50 overall, but with healthcare and utilities lagging pretty significantly, and IT once again beating on the majority. Lastly, economic outlook. The employment rate has increased to 14%, but we are expecting a decrease moving forward. Thank you, and I will pass things over to Jack.